that's typically how people make the highest rates of return on their investments, is if they can keep that money moving throughout the system.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer, ADP. I'm glad you're here. Now let's dig in.
Hello and welcome to the Freedom Point Podcast. My name is Drew McWilliams and I am going to be your co-host alongside my partner Jeremy Dyer today. Today on our show, we are going to be talking about one of our most recent transactions and closings with one of our real estate syndication partners, Rise 48, out of the Dallas, Texas metro area. Hello, Jeremy.
Thanks for having me, Drew. Pumped up, excited to talk about North Arlington.
Let's go. Let's dig in. So, Jeremy, one of the things that I absolutely love talking to you about is all the different opportunities that cross our desk and all the different things that we get to look at before we publish them and talk about them to our database of different people. Here's what I think is missing out there in the podcast world, because we know there's many real estate podcasts out there. Let's just admit that. But here's what is missing. People don't talk about what deals and opportunities and transactions and closings have happened and why they like them and why not. I would love to unpack with you every time that we have a opportunity investment that closes, because we have to talk about a little bit past tense, that we talk about why. Why did we like it? What did we like? What did we not like about other ones that we turned down? What do you think?
Yeah, no, I love it. And I'm very thankful that you brought the idea up. And just to throw this out there for SEC compliance purposes and reasons, we can only talk about opportunities that we had previously participated in, where that deal has now officially been, under contract. It's been sold. It's been acquired, by the new sponsor, by the new operator. So we can't really have discussions about anything that's coming up in the future, on a podcast or any particular investment deal or opportunity that we have that's active. So I just wanted to kind of throw that out for our listening audience. But yeah, very excited to kind of unpack what is being rebranded as Rise North Arlington. And I would like to address Rise North Arlington, and in terms of what your questions are, as a limited partner investor. Whenever we look to help raise capital for future opportunities, we always come alongside of our investors, and we invest our own capital into those properties to show a true, alignment of interest. So in answering your questions today, I have my limited partner hat on today as an actual investor in that project with my own money.
I love it. And I'm really glad you said that, because that is a big deal. We are in the same mindset that we will only talk and promote opportunities that we are personally involved in ourselves. So I love that. And I'm excited. We've done now 5 together just this year, and it's only July. So I'm excited to dig in. Let's talk about more. What did you like about, this Rise North Arlington opportunity whenever it would cross your desk the most?
Yeah, there's a lot that obviously I can unpack about this particular opportunity, but for the listening audience, it's 270 units in North Arlington, Texas, which is an MSA of the Dallas market. It's a B plus class asset in a B plus class neighborhood. There's a lot about particular classes and how they're determined that we could talk about a little bit more in this episode if you'd like to. But what I really liked about this particular asset is it's a 1980s build, 270 units that are all classic. Okay. What that means is that all of the internal units still have finishes from the 1980s. Okay. And I think about my own home. I think my wife would like to renovate the house that we live in about every 7 years. So we're talking about an asset now that is very dated on the interiors, 40 plus years in some cases. So assets like that traditionally will have your Formica countertops, old cabinet boxes, lots of broken cabinet doors, white appliances, right? Old flooring, carpet, the color schemes are off. The pool might not even be open and operational, right? The exteriors, the landscaping. So this particular asset, the main reason why I was very attracted to it is because with my own particular risk return investor profile, I really like opportunities that generate immediate cash flow, which I knew this particular investment would because of where occupancy levels are today in their present conditions. But I also liked the opportunity from an equity play perspective, meaning I knew if the right operator purchased this particular asset and they went through their repositioning efforts with the asset, meaning they turned over the units in what we call a value add strategy, I knew that there was a significant opportunity with this one to burn off what they call loss to lease. Okay. Loss to lease is basically the difference between what the asset is getting today with an average unit versus what the property may be on the other side of the street or within a couple of mile radius of the property is getting fully renovated. Okay. Or what the new product is getting. So in some cases, you have units that may be, if they're, 2 bedrooms, 1 bath, they might be getting $1,400 per month. Whereas if you look at that competitive asset that has a already repurposed unit or renovated units, if that operator is achieving rents of $1,800 to $2,000, you have a significant loss to lease that the operator can burn off through a value add repositioning of that asset.
Yeah, I love it. So again, I'm going to put on my LP, my limited partner hat on, since I'm a personal investor in this too. So here's what I look at, which I'm hoping you can describe this term a lot more simplistic than I can. What I look at when I invest in properties like this is something called vertically integrated. Can you kind of unpack that? What does that mean? There's a very complex term. I think it's thrown around a little too much. What is it, and why is that important? Because I know that was one of the things I loved about this opportunity.
Yeah, it's a great question. So it really comes down to boots on the ground and who's wearing the boots. Okay. It's usually one of the two things. It's either the operator that owns the asset and is going through the renovation efforts is vertically integrated, meaning they have their own in-house property management company. They have their own in-house building construction company, and they're vertically integrated in that way. The other side is hiring those two services by way of a third party. So a third party property management company that's hired. And if they do really well, excellent. If they're not performing, you fire them and you bring in somebody new, right? To fill those boots. Okay. The same thing can be said on the building construction side. I really like operators that have a vertically integrated building construction side, because when you're talking about renovating 270 units, when you're talking about replacing or displacing, that many tenants over the course of a 16, 18, 24-month period, a lot of operators will talk about a full blood replacement, okay? Meaning that after they've renovated those units, there's no one living in any of those units that lived there when they first acquired the asset, right? So all of that takes a team. Okay. It's not a team of 1. It's not a team of 10. It can be literally a team of 20, 30, 40, right? And so I like operators that have those local boots on the ground. They can control the property management side. Usually those property management entities within the sponsor, their goal is just to break even The goal for the property management company is not to make a profit. The margins in the business are relatively slim anyways, but their goal is really to break even so that they can complete those renovations as quickly as possible, which ultimately leads to more than likely, no guarantees, but it usually means a higher return for the investor and a quicker point to which the operator can look to sell that asset off to the next sponsor, or in fact, maybe look to sell it off to an institutional buyer who's looking to purchase a turnkey asset.
Yeah. So let's talk about something that you just said. Quicker return. I know in our industry, we look at a term called IRR. Okay. And I know the IRR for this property projected, I'll call it, is 16.9%. Okay. I look at that as a extremely important metric. I must say it's one of my top two for me personally. What is IRR and why is that so important? And quite honestly, I know a lot of people say that is considered the gold standard when looking at properties. Correct?
Yeah, absolutely. So there's quite a bit to say there, so I'll try to unpack it. One thing to just say about your 16.9 is anytime a sponsor has a new opportunity and they're projecting rates of returns, whether it's an IRR projection, an equity multiple projection, a projected hold period, an annual rate of return, please understand those are merely just projections, okay? So they're not worth the paper they're printed on, okay? When it comes down to the sponsor's ability to produce those types of returns for their investors, it all comes down to the sponsor's ability to execute that value add business plan. Some sponsor teams are a team of one, some are sponsors are teams of 10, and some, which like the ones that we traditionally like to personally invest with, are teams of 200 or more, right? So really you're putting your trust, so to speak, or faith in that operator's ability to produce those types of returns that they're projecting. So let's get to the IRR. So one thing that you mentioned is returning that capital plus the profit and distributions back to the investor as quickly as possible. I personally love the law of velocity of money, okay? Trying to get money to move as fast as I possibly can from the time that I deploy it into the asset until the time that I remove it from that investment. That's typically how people make the highest rates of return on their investments, is if they can keep that money moving throughout the system. So on the IRR, it stands for internal rate of return. Its stepsister is called the annual rate of return. The difference between the two is the internal rate of return largely takes into account what we call the time value of money, or future cash flows that the investment will make the investor during the course of the deal hold period. One big component to the difference between the annual rate of return and the internal rate of return is the time value of money, inflation. The value of $1 today does not hold the same value as $1 tomorrow. So when we look at opportunities, certainly one of the metrics, assuming the underwriting checks out, right? Assuming that we feel confident in the sponsor's ability to perform the value add business plan, IRR is a great metric to look at, but it's not the only metric that we look at.
Yeah. I think that was great information, and great to kind of explain what that is and why a lot of people look at that, right? I'll say when folks call me, because I've got a lot of friends, colleagues that call me, and every once in a while they'll say, "Hey, Drew, can you look at this? This opportunity came in front of us," and I am happy to do so, and I know you do so for a lot of folks too. I mean, it's all about giving back and doing goodwill, right? And I had a friend that sent me an opportunity. I'm not going to name drop, but it was an opportunity up in the Boston area. Okay. And this was in the last 30 days. He sent me this: "Hey, Drew, what do you think about this? I'm thinking about investing and going in on this property. And it took me about 5 minutes. And I sent him back an email and I said, I would look at this, 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 and this. And here's one of the things and he called me and he said, wow, thank you. I'm not going to invest. And I wasn't trying to talk him out of the opportunity. I just was fact stating. And here's something that is, I said, I look at top 2 things, right? Like I've got a top list of things that I look at whenever I evaluate opportunities. IRR is definitely one of those top 2, I'm not going to lie. Here's the other one. I look at the average cost per door. So let's unpack that. What does that mean? That means the total purchase price of the property divided by how many rental doors are in that facility. Okay, that is a big deal to me, and here's why. All right, there's a new construction project up in the Boston area, and a operator, syndicator, sponsor, whatever you want to call them, they're not going to advertise. Typically, I've never seen anyone advertise the average cost per door. I just haven't. I just do that calculation myself, on paper. Their average cost per door was $479,000 plus per door. Okay. In comparison, the exact same week that this Rise North Arlington project came out, that average cost per door was $132,000. You want to talk about a quarter, of that cost. So to me, that's an important metric, especially because the cost of new construction and everything is just so overinflated right now. I don't want to overpay for a property. So yeah. I don't know what your thoughts are on that.
Yeah. And obviously Boston is not Dallas, right? So, real estate is always local. And I try to explain that to people. Like when you see, the headline that says this or that related to the real estate market, you've got to understand there are multiple different real estate, classes or types of assets, right? So when you see the, high level, or what type of commercial properties are we talking about? Are we talking about, assisted living buildings or multifamily or flex office or retail? There's all kinds of different, asset classes. And further within that discussion, is where that particular asset is located in the sub-market, right? Or the neighborhood. All right. I can tell you right now, I live in the Minneapolis, St. Paul area. I live in a nice area. Okay. But I can tell you, I can drive 5 miles to the west and I'm not in a nice area. Okay. And I can tell you the average cost per door 5 miles from me is very different than the average cost per door where I live today. So you bring up a really good point, and that is, when sponsors are underwriting deals, that is a significant metric to look at, even as a limited partner investor, to really dive into the competitive local market that property is located in. So to your point, if Rise North Arlington was $132,000 per door, if a competitive asset in that same market that was built around the same time, not repositioned, is achieving something that's, $10,000 per door per unit higher, to me, what that says is it's probably a property management issue. It's a management issue of that asset. Okay. There's a reason why the competitive assets right across the street, built the same year, same amenities, are getting $10,000 per door more. It's a management issue. Okay. But now let's take a look at that repositioned property. And let's say that repositioned property is getting $50,000 per door more, okay, and it's in the same market than the asset that you currently own. That bleeds into that discussion that we talked about before, and that's that loss to lease, right? So how much money can the sponsor put into each asset so that they can feel confident in increasing rents, increasing the net operating income, and ultimately, getting the types of returns that they expect for investors at that expected market cap rate, at the end. So great point. The other thing that you can look at, Drew, is the new development. Okay. In most areas of the country, there are new development properties or projects that are, constantly going in those particular areas. So, what does the absorption rate look like for that brand new ground up developed apartment community that might be 5 miles down the road? If the absorption rate of that newly renovated product is struggling to get over 60%, that's a huge red flag for me. Okay.
Yeah, I think that was great. I think that was all valuable information. And I hope listeners really understood exactly what you just said. If not, I hope they hit the rewind button, a couple times on that one to unpack that a little bit more. But, going back to something that you originally said, real estate is very market by market specific. Anyone that says, oh, real estate is bad, what a general statement. Like is real estate, it is completely different from you're in Minneapolis. I'm in Charlotte. We talked about Boston. We talked about Dallas. How about Phoenix? How about Seattle? You can't make a broad stroke. You got to really take it market by market specific, right?
Yeah, absolutely. And one other thing I thought about when you asked me that question about the internal rate of return is there's something called the rule of 72. I don't know how many people have heard that before, but you can use that metric in real estate investing. And you can also use that, I shouldn't say metric, that rule, okay, in really any other type of investment strategy, whether you're buying T-bills or you're investing in Tesla stock or mutual funds or wherever you should happen to deploy your capital. And the rule of 72 basically goes like this. You take the number 72 and you multiply it into the interest rate or the internal rate of return or the annual rate of return. So 72 divided by whatever that projected internal rate of return is, or that interest rate if it's in a money market account or something like that. And that will tell you the amount of time in years that it will take to double your money. So a real simple calculation that we like to project with most of the investments that we put our own capital into is we like to use, typically a 16% internal rate of return is kind of what we target. Sometimes it's substantially more than that, depending upon, the investment and how the operator did in repositioning the asset and selling it. But if you take the number 72 and you divide it by a 16% internal rate of return, you're going to come up with about 4.5. And what that means is that if the investment produces a 16% internal rate of return, over 4.5 years, you will have doubled your money in that particular investment.
Love that. Great role. Hope everyone writes that one down. That's pretty good. Anything else that you liked about this opportunity that made you personally invest in this property in Rise North Arlington?
Yeah, we can talk about the local market. We always like to look at, job growth and job diversification or diversity. When I say, job growth, obviously is the market adding jobs. What are the major employers in that particular area? Because quite frankly, most of what we invest into is really going to be that workforce housing, right? Where most of the population lives. Okay. So we're really looking for the major employers that happen to be located in that particular market. We're also taking a look at other corporations and are they spending in that market, right? So are there other employers that are looking to move into that particular market and build out infrastructure, or really create jobs? The other thing that we like to look at is job diversification, right? We know what happened in the Detroit market back during the global financial crisis. That market was largely centered around the automotive industry, right? So there wasn't a lot of job diversification in that market. We could say the same thing about Las Vegas, right? Similar challenges that Las Vegas has been having, since the onset of COVID, because a tremendous amount of their economy in that market is centered around tourism. It's centered around, the Vegas Strip and areas like that, in that market. Yeah,
I think it's a great point to bring up too. Outstanding. Any last words of wisdom about, what to look at when someone's evaluating an opportunity, or what you might have, liked or looked at in this opportunity a little bit more?
Yeah, I would just encourage investors to dive deeper into, what some of the projections are, because keep in mind that projections are just merely projections, okay? And that's what you're going to find on an investor presentation. I'll give you one example. I had a friend just like you that sent me an opportunity to invest in a multifamily property, and the equity multiple that was projected was 2.4%. We rarely see opportunities where the sponsor is projecting a 2.4% equity multiple on an investor's money. For those that don't understand equity multiple, a 2.0 equity multiple would in effect be doubling your money over that hold period, right? So
your initial principal you're talking about.
On the initial principal, that's right. Yep. So this particular sponsor was projecting a 2.4% equity multiple, which to the non-savvy investor, that looks much better than the 2.05 or the 2.08, that we might be projecting with some of our, sponsors that we help raise capital for. The challenge with it is theirs was based on a 10-year hold period. Okay. So a 2.4% equity multiple over the course of a 10-year hold period is not as good as a 2% equity multiple over maybe a 3 to 5 year hold period, if that makes sense.
Yeah, 100%. You got to do the math, do the education, and figure out exactly, what the numbers mean, for sure.
Yeah. And do your own due diligence. I mean, it's not that difficult to take a look at, what the sponsor is projecting, when the deal goes full cycle in terms of what they project the exit cap rate to be. It's not very difficult to look into the debt service that the sponsor has, on the opportunity. Did they purchase a rate cap, right? And if they purchased a rate cap, do they have an option to extend in the event that they, hit that rate cap, right? Another big one is just, diving into some of the pro forma numbers. Have they accounted for an increase in labor costs and material costs and insurance costs? Are they fairly projecting what they think they can get for the new product rents, right? Are they projecting to get rents after the newly renovated units that are significantly higher than what competitive assets in that same, market, are achieving today? So I would just encourage investors to take time to really dive into, some of the details, some of the specifics, of that investment, and don't be shy. Ask questions, okay? Especially if you've never invested passively before into a real estate syndication, highly encourage you to ask questions. I'm a really big fan of a book, so I'd like to give a quick shout out of a book that I recommend that everybody reads, and that is The Hands-Off Investor by Brian Burke. It's packed with information that would be very difficult for Drew and I to get into one podcast episode. So do your due diligence. I'm a really big fan of investors having the proper education. I believe that people shouldn't pull the trigger on a passive real estate investment until they truly understand what it is that they're actually investing into, if that makes sense.
Yeah, I love it. Thank you for dropping that book. It's a great one. I've read it myself, and it was one that you recommended to me whenever I first got started doing this. So appreciate that. Jeremy, thank you for your time. I would really love every investment opportunity that closes. I would love to do another one of these. Like, I would really love the audience to learn, what did we like? What did we maybe pass on? There could be other opportunities as well, because I don't think anyone else is doing this in this space. And again, I'll continually say it, education is key. And the more that we can teach people of what to look at and why we like and why we don't like something, hopefully we can help them shape their financial goals and become financially free. So, Jeremy, last thing, if anyone wants to connect with you, what is the best way to connect?
Yeah, thanks for the question. I'm relatively active on LinkedIn. You can find me there under Jeremy Dyer. And then you can also visit startingpointcapital.com. Again, that is startingpointcapital.com.
Outstanding. Thank you, Jeremy, for being on the show.
Drew, thanks for having me.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.